welcome everyone to Legal Funding Journal's virtual town hall spotlight on insurance. I'm your host, John Freund, managing editor of Legal Funding Journal. So thank you all for joining us today. We've got a really great panel. We're really excited for this topic, and we have a lot to cover. So I'm just going to make this housekeeping very quick. Just a few things. First of all attendees will receive a link to a recording of this event. So please stay tuned for an email post-event with a link of the recording. Also, the format of today's event is going to include a panel discussion followed by a Q&A with you, the attendees. So that means we encourage your questions for the panelists. There's a couple ways you can do that. One is by submitting questions via the comments feature on LinkedIn. You can use that there at any time during the event. You can also email questions to me. That's jfreund@litigationfinancejournal.com. That's jfreund@litigationfinancejournal.com. Please submit those questions throughout the event. We'll get to as many as we can, time permitting, at the very end. Also, we will be hosting virtual town halls on a monthly basis. We're going to be addressing themes and topics that are important to our community, and we hope that you'll join us again and again at future events. We'll be doing this again monthly. So please stay tuned for the next event in October. Lastly, Legal Funding Journal is the most comprehensive source of news and events taking place in the legal funding sector. Members rely on LFJ to stay on top of case developments, funding activities, regulatory updates, and people moves, as well as to gain access to original content produced by some of the leading thought leaders in the space. So if you'd like details on becoming a Legal Funding Journal member, you can visit us at our website, www.legalfundingjournal.com. With that, I'm going to turn it over to our moderator, Jim Batson. Jim is Chief Operating Officer at Westfleet Advisors, a leading litigation finance advisory firm. With extensive leadership experience in the industry, Jim joined Westfleet Advisors in 2024 after serving as U.S. Co-Chief Investment Officer at Omni Bridgeway, where he played a key role in driving growth and innovation. As a former partner at Little & Robinson, Jim brings deep expertise in deal structures, market trends, and strategic advisory, helping clients navigate complex litigation finance landscapes. Jim, please take it away.
Thanks, John. And thank you to the Legal Finance Journal for hosting what I'm certain will be a fascinating discussion. At Westfleet, we obtain litigation funding solutions for our clients. We're seeing more and more solutions involve a combination of contingent risk insurance and traditional litigation finance. And so we have four esteemed panelists, two from the traditional litigation funding sphere and two from the insurance world, to help us learn more about what's been going on in this space. And with that, let me introduce our panelists. First off, we have Jeremy Marshall, who is the CIO and Managing Director of Windward UK Limited, which is the UK advisor to a litigation fund. Before this, he has been involved in every facet of litigation funding from well over a decade. Whilst in private practice, his cases were funded by the likes of Therium, Bannon, and Woodsford. He was a senior investment manager with Omni Bridgeway, a director of its UK business, and was the company's representative for the Association of Litigation Funding. He has also been the chief investment officer of Bentham Europe Limited, now Insworth Advisors, which was a joint venture between IMF Bentham Limited and Elliott Management. Next up, we have Steve Jones. Steve leads the Gallagher litigation practice, ranked band 1 by independent rankings agency Chambers and Partners in each of the last 4 years. In addition to his work in litigation, Steve also heads Gallagher's M&A and tax insurance offering. Steve is known for providing creative solutions for claimants, defendants, funders, and insolvency practitioners. His relationship with insurers, coupled with his extensive market knowledge, drives good customer outcomes. He has developed a particular practice in contingent risks, acting for defendants to a dispute alongside his established ATE and judgment preservation expertise, which is predominantly for plaintiffs. In recent years, Steve has developed a reputation and specialization in developing capital protection insurance solutions. Next up, also from the insurance industry, is Michael Parrish. Michael is a director and head of litigation insurance in the transaction liability practice at Lockton. Prior to joining Lockton, Michael spent much of his career working at the world's largest litigation finance company, Burford Capital, as well as a Chambers-ranked litigation finance broker, Westfleet Advisors. In these roles, he helped a wide range of clients, including multinational corporations and AmLaw 100 firms, use innovative litigation finance structure to achieve their financial objectives. Michael has been recognized by Law Dragon as one of the top 100 global leaders in litigation finance and is listed in the IAM Strategy 300, a guide listing individuals who innovatively create and action strategies which realize and amplify the worth of IP portfolios. And last, but definitely not least, Dave Kerstein. Dave is the founder and managing director of Arcadia Finance, a commercial litigation finance company based in New York. Prior to founding Arcadia, Dave was one of the co-founders and managing directors of Validity Finance, where he co-led origination, underwriting, structuring, and monitoring of investment opportunities. Dave began his career in litigation finance at Bentham IMF, now Omni Bridgeway, where he spent 4 years as an investment manager. Before that, Dave spent 15 years as a trial lawyer handling complex commercial disputes at a leading international law firm, Gibson Dunn. Dave is a sought-after speaker and recognized leader in litigation finance. He has been named among Law Dragon's Global 100 Leaders in Legal Finance and selected by Who's Who Legal as a thought leader in third-party funding. Okay, now that we've gotten the introductions done, let's dive into the program. And starting with you, Dave, as Arcadia is a relatively new player in the litigation finance space, how has Arcadia approached incorporating insurance products into your underwriting and claim selection processes?
Well, first of all, as we were raising capital for Arcadia earlier this year and late last year, we explored using insurance to possibly wrap a future portfolio to potentially help drive fundraising and lower cost of capital. Weren't able to do that as a first-time manager, but it's certainly something we're going to intend to explore the next time we fundraise. While we're now, to your direct question, while we're operating the company, we will certainly be exploring some of the more kind of traditional insurance products, JPI, and potentially wrapping certain portfolios that, may be a little bit on the edges of our mandate, but wrapping them in, they're good risk, and wrapping them in insurance would help us get to yes to invest in those kind of opportunities.
So do you think, Dave, that by having insurance available, you're able to look at some deals that you might not otherwise have been able to consider?
Exactly.
Great. Steve, could you give us an overview of the current state of the legal insurance market, especially focusing on recent developments in capital protection insurance?
Yeah, I'd be delighted to, Jim, and nice to see everybody. So there's a couple of points I'd make about the general state of the legal insurance market at the moment. Particularly at the moment, I'm seeing a lot of innovation. So it really does feel like no two deals are the same that we see. There's a lot of creativity to get deals done at this moment in time for reasons which I'm sure we'll come on to later in the panel. Very high submission rates at the minute, which I think probably suggests that the knowledge and understanding of the products is increasing. And I see insurers and funders collaborating on every deal, in particular, CPI, as Dave just said there. It's very seldom we see funders approach or consider a deal or a portfolio of deals without thinking about insurance. And CPI, capital protection insurance, being the most obvious example of that we're seeing at the moment. For those that don't know, capital protection insurance is a relatively new concept. It specifically targets those putting direct capital or work WIP at risk and aims to protect their investments in litigation cases. It will cover adverse outcomes such as losing the case, the incoming damages not meeting a threshold level to repay the investment, or not making a recovery in a specified period of time, usually 5 to 7 years. So it protects against that duration risk. And the insurance will pay out in those circumstances, and that has the benefit of attracting new stakeholders into the space, bringing down the cost of capital by de-risking the investments, or as Dave just said there, helping the investment committees of the litigation funders that we work with get to good on a particular gating issue. Net result of all of that is increased choice for clients, which I think we'd all agree can only be a good thing.
Yeah, Steve, you mentioned capital preservation insurance and its components. Does that also involve protection against duration? I know in the funding world, that's a particularly sensitive subject.
Yeah, absolutely, Jim. So as I just mentioned, that's one of the perils that can be covered, regularly is. Generally, we call it 5+2. So the policy holder is entitled to make a claim after 5 years and within 7 years. So that then will pay back the value of the outstanding principal up to the policy limit, which gives that certainty. It's particularly useful in secondary market transactions for reasons which I assume are obvious.
Great. Jeremy, how has Windward utilized insurance products in your funding strategies? And again, given your expertise, I'll ask particularly in international arbitration cases.
Not as much as my insurers would like is the answer to that, just on the basis of what we've been looking at recently. But it is true that in the international arbitration, and in fact, one other example in the Netherlands that we've been looking at, it's been looked at in three ways, two of which basically the flip side of what Steve's just been saying, because the first example was to see in a sort of quasi bilateral investment treaty case whether it was possible to essentially insure the capital investment sum, or conversely for the client to insure the whip of the lawyers, which in a sense ends up in the similar kind of result. And in the Netherlands, it wasn't an arbitration, but there we were concerned about the solvency of the defendant, the target. And again, for that, it was to see whether we'd be able to insure the principal investment sum, and indeed to try and find a way of also ensuring slightly some of the upside with some collaborative work with the lawyers. So it's true that insurance is a critical component to a lot of the work outside the traditional AT market that, of course, we know and love.
So it's great. In the first 5 minutes of the discussion, we've talked about how insurance can help raise funds, as Dave noted, preserve or minimize risks in a variety of different ways, as Steve noted, and facilitate deal structure, as Jeremy just covered, which puts a lot of pressure on you, Michael, for the next question. But how do you see the role of insurance brokers evolving in facilitating cooperation, as Steve touched on, between funders, insurers, and law firms?
Yeah, no, and thanks for that, and thanks for the high bar here. So in terms of what I think the role of insurance brokers are useful here, and there's a lot, but I think it's really making sure everybody is rowing in the same direction when it comes to understanding deal structures, understanding how the give and take that might be needed between a law firm, a funder, and the insurer, and to make sure that if there are hiccups, which invariably there will be hiccups, there's enough goodwill that has been created among the parties that we're going to be able to figure out how to solve those hiccups and continue to move forward with the transaction. I'm sure, Steve, you've experienced this, Jeremy, Dave, you've all experienced this, Jim, you as well. No deal is without some types of twists and turns, and having someone there who understands the space, understands the funding world, understands what the lawyers are going through, and can act kind of as that intermediary to make sure there aren't ships passing in the night and no one's kind of getting overly emotionally invested in a particular point, I think really is very helpful. It's also helpful for the insurers to understand why litigation funders charge the rates they do, for litigation funders to understand why the insurers charge the rates they do, and to make sure both sides kind of understand all the economics of the transaction. And as litigation funders or other capital sources, start to get involved in these transactions, we've just noticed that coming up more and more and more, and kind of explaining how all those parties should work together.
And it sounds like you're describing in some instances where you're playing sort of a mediator's role. Is that fair?
Yeah.
Or am I overstating it?
I think that would be. I mean, Jim, you've done this a lot when you've been in the not only in the litigation funding seat but now in the advisor role. A lot of that is going to be making sure we come to some type of meeting of the mind. We're always going to be, as the broker, very aggressively advocating for our client, but we also want to make sure that we're getting to the right answer and solving the financial needs of our client, the financial needs of, what they want to accomplish out of the transaction. So sometimes there's going to be a give and take, and that's just something we all have to be aware of going in. I'm sure, Steve, you experience the same thing when you're working on this as well. So,
of course, yeah.
But once the case has been funded, I'll toss this out to Steve or Michael. At least my experience had been, maybe fortunately, it's pretty rare that the insurance broker and/or carrier gets actively involved unless it looks like there may be a need for a potential claim, and outside of any ongoing reporting obligations that the user of the insurance, whether it's the funder or the claimant, has. Would you agree with that, or do you think maybe
No.
I just lucked out and that you're more often involved during the pendency of the deal?
No,
I don't mean
no.
lucked out like I don't want to deal with you, Steve. Just if you don't need insurance, that means things are going well most of the time.
Well, obviously I'm based in London, and the genesis of the insurance market here in litigation was ATE. Okay, so this is adverse cost insurance. We have it on every deal, and by definition and by nature, this is first instance litigation. So there are a lot of touch points. There are interim applications. The policy limit that's set at the start of the case isn't always reflective of the policy limit you need going through. Sometimes the clients change their lawyers. There is a lot of interaction, and what the broker brings is some consistency to that. Okay, our primary role in life, and Michael will absolutely agree on this, as he says, we aggressively advocate for our clients' best interests in pricing, etc. But our entire role in life is making sure claims get paid. That is it. That is what a broker does. Okay, that is the product. We need to make sure that if we get to the worst and there is an adverse outcome, that everything has been done by our client and by extension by us to make sure that claim is paid. Otherwise, the product has no value, and therefore this industry and all of us talking on this call, the sustainability goes overnight. So that's what we need to do. So no, we actually stay involved cradle to grave, and I have a team now who just work on case management and are not involved in the placement aspect of it whatsoever.
And to echo Steve on that point, same things happen here. I think there's a difference between the types of policies. So if it's a judgment preservation policy, the level of involvement is not going to be as active because the table's been set already, and we kind of know, hey, we're going to appellate argument. The argument's going to be heard. I mean, there's not a lot to be doing. When we're talking about some of these portfolio products where there can be alterations of counsel or litigation strategy, or sometimes even, maybe the terms of the litigation funding agreement have to be changed because there's some type of dispute arising or brewing between the claimant and the funder, or between the lawyer and its client. We have to make sure we're always on top of that and informing the market in real time about those updates. Because as Steve pointed to, our job is to make sure we're keeping everyone informed and to make sure claims get paid on that point. I think that's important. We've also, dedicated claims people dealing with that particular side of the business too, because I just think it's a really important component to have.
Thank you. Dave, you touched on how insurance has helped you do some deals. I know Arcadia's in its early days, but you've been in the industry for a long time. We worked together for a long time. Can you give some examples or an example of a case where insurance enabled you to fund a matter that you might not have otherwise been able to fund? And
Sure.
Maybe why?
Yeah, sure. A few different examples come to mind. One, at my prior company, we had a really interesting domestic arbitration under, I can't remember now if it was JAMS or AAA. And it was a potentially really valuable opportunity, but in the underlying contract that was a dispute, or contracts that were in dispute between the parties, there was a potential for fee shifting back to the plaintiffs if they, in the unlikely event that they lost. And there was some concern that if that happened, that could get shifted onto us as the funder if the plaintiffs were impecunious. So, sort of a very traditional use that happens, I think, more in international arbitration, less so in domestic. We were able to help arrange for the plaintiffs there to get ATE insurance in New York, which is actually not the easiest endeavor because it's not often used in New York. But by arranging for and helping the plaintiffs, claimants there, obtain ATE after the event insurance, it protected us in the event of a loss from those costs coming back to us and allowed us to ultimately close that transaction.
Got it. No, that's helpful. And I'm glad you mentioned ATE insurance because Steve did too. And for those of us in this world that may not be familiar with that, in the UK and in Australia, it's common for there to be fee shifting where, as they say, loser pays the winner's attorney's fees. And ATE, or after the event insurance, is been a traditional market in those jurisdictions, but as Dave noted, not typical in the U.S. So because we don't have that, it's the American rule versus the international rule. So
that's correct.
Yeah, thanks.
I'll just add in
Please.
to that actually that for the benefit, as Dave says, there fee shifting obviously not as common in America, but you can use the ATE product to cover off the risk of a counterclaim as well. So the deal that I've got on my desk as we speak today is it's an American case in Delaware, and the plaintiff has gone to funder. Funder's going to fund the case in the traditional way, but there are two extra exposures, one being the risk of cost shifting, because that applies in this particular contract, but secondly, the counterclaim damages. And at the moment, even though the counterclaim is not considered to be that strong, the funder's not going to pick up the tab if it does all go wrong. That leaves a gap for the not quite impecunious, but not far off client, and the risk is just too high. So the funder's going to pay the insurance premium. My policy is going to cover the risk of the adverse costs and the counterclaim. So it's just another innovative way that we can take the same peril and bespoke it for the individual needs of the client, the funder, and the case.
Terrific. No, thanks for that. That's really helpful. And sticking with you for a second, Steve, look, we've all, at least those of us, in the litigation finance space, initially, at least as a funder, I always thought of insurance being what we now call JPI, judgment preservation insurance, namely cases won at trial. The client and or the funder wants to ensure that their investment at least retains some value if it's reversed on appeal. But that's evolved. But we've heard about some that there have been some big losses in the industry. Some have been reported on by some of the legal press. Others, there's sort of the rumor mill. Assuming that's accurate, how have those recent losses in the JPI market specifically impacted insurers' willingness to underwrite these types of policies? And in light of that, or maybe just the maturation of the industry, what types of alternatives are emerging?
Where are we going with it now? Yeah, okay, all right. Well, yeah. Thanks for this hot potato relevant question.
Well, you had the easy question. Now you got to get the hard one.
Yeah. This is very in vogue, and I've got to own it. And some of those deals that have not gone so well in the market are ones that I placed. But to give some context, I've placed in my career, and Jim, you and I have done a number together. I've placed over 30 of these types of policies over the last 6 years, and less than 10% of those have resulted in losses. So it's a small percentage. However, when they go wrong in this particular space, and the way that the JPI market's been set up traditionally, when they go wrong, they go really wrong. And as a result, the position is absolutely that at the moment, that market is in a state of challenge, is what I would say. It's not dead. I have a JPI policy in underwriting at the moment, so it's not dead, but it is challenging for the types of deals which have been traditionally insured, which have been large plaintiff side judgments, mostly quite often in the intellectual property space, where, as you say, external capitals come in to monetize those judgments, and the funders have sought to wrap those investments with a policy, or indeed the policy. The judgment holder has sought to purchase insurance for a wrap and then monetize against the insurance policy. So that type of deal, where it's the plaintiff side trying to seek to de-risk a large percentage of the judgment, that is very challenging at the moment. There have been some exits, some insurers, carriers et al. Have pulled out of the space, and certain individuals have left the space. However, that's the bad side of it. That's the context, if you will. On the positive side, the insurers that remain have learnt lessons from what we've seen over the last couple of years. And I would say it was a period of reflection and resetting at the moment. The insurers that remain in the space are not running for the hills, but they are looking to do it slightly differently. And that was the basis of your question. So what does it look like now? Well, defendant side JPI is still very much alive and kicking. And defendant side JPI is actually where this started. So a situation where a defendant has had a finding of no liability. That's then being appealed by a plaintiff. They've got to hold it on their balance sheet, or it's holding up an M&A transaction. Mike does a lot of that type of work in a transactional context. Absolutely those types of deals where there is a secondary reason a motivation for the insurance, which isn't just we want to lock in our result and run. Those deals are still very much getting done. On the plaintiff side, we are seeing, as you can imagine, a hardening of pricing. So the pricing is going up. In order to moderate the upfront element of the premium, some of the deals we're seeing at the moment have got a back end success fee. So the insurer shares in the success back end. There we are seeing individual insurers provide lower limits against what they might have done before. They might have done 50 million of insurance on a particular case. That might now look like 15 or 20. So it's quite a significant drop off, but they're still doing it. And final sort of summary point as to where I think the market might go. I think a couple of years ago when this whole space started, funders were monetizing the judgments. Then for a period of time, the insurance sort of jumped over that and we saw the judgments being insured and then monetization deals being done at the back end. I actually think now we're going to come back full circle and we'll see litigation funders coming in and monetizing the judgments up front in the way that they were doing so 5 or 6 years ago. So I think we might see a full 180 on that.
Yeah, fascinating part of that. Thank you for that. To me at least, is the insurers somewhat playing the role of litigation funders in the sense that they're taking less of a premium, which you could then say is investing part of the premium, in exchange for some of the upside if the case is successful. Not that different from what funders do, although rather than reducing a premium, they're putting funding at risk. But yeah, it's another good example of the creativity. Jeremy, let's come back to the litigation funder side of things. How do you view the relationship between funders and insurers? Some people, and I guess in some contexts, myself included, have thought of insurers as competitors to litigation funders. A simple example being in the appeal context. The client has the option of taking funding as a way of de-risking and getting capital right away, or taking insurance as a way of de-risking but getting capital at the conclusion of the process. But then we've heard a lot of discussion about insurers and funders working together. How do you see that dynamic currently, and how do you see it evolving?
Yeah, I think it certainly would be the case. We know litigation funding without insurers, and I myself think that the lawyers are more of a competitor than the insurers, actually. So I view it very much as a collaborative venture. I mean, in England, for at least 2 specific reasons. One is the Competition Appeal Tribunal, which we all know and love in the UK. I mean, you couldn't go into the CAT without support of the insurance market absolutely to the limit. And that morphs into the concept that's growing of co-funding, which again, you wouldn't be able to do without a great deal of collaboration with insurers, particularly when you're in a situation where maybe one funder's got a policy, portfolio policy with an insurer. You're invited to sort of participate with somebody else, if it's maybe syndicated, maybe more than one funder. All the insurers are going to have positions in relation to that, and without some give and take, particularly if there's a carriage dispute to throw in, you're not going to get it off the ground. So it really is a team effort. I mean, Steve alluded to other reasons why it's a team effort, because things, as we all know, no litigation funding agreement and case goes without its ups and downs, more downs than ups. And where you have to be looking at security for costs applications, or where you've got deeds of priority that need to be looked at and amended and revised, without a good relationship with an insurer, you're not going to get off the ground. And it's particularly important where you're having to deal with a client-facing kind of position. You want insurers and funders to be speaking with the same voice in relation to that. And often you will see in points of tension where clients, and even, I'm afraid to say, the law firms sometimes will seek to try and play a divide and rule game with the lawyers, insurers, funders, and client. And we need to be with a concerted and uniform voice if we can. And certainly that's my view, and I would think it will only grow in time in relation to that as the market develops and the insurance products become more and more embedded in the transaction, so that you will, I think, see insurance playing a bigger role at the front and the back end of a transaction.
Thanks, Jeremy. And I don't want to sidetrack the discussion at all, but I'd be remiss, I think, if I didn't ask. You made a comment at the beginning of that saying you see lawyers as more competitors sometimes than insurers. I'm curious what you were referring to on the lawyers part of that.
Well, I mean, any good entrepreneurial law firm will realize that what they can do, if they want to, is either have a DBA, damages-based agreement contingency fee structure, or they can seek to insure their WIP and then trade off that WIP to try and leverage that against us as funders to try and get a better deal, to say, well, look, we're going to get you get a guaranteed return here, so we're going to try and get a better deal from you. And if they're clever and do that with AT as well, then you're actually, as a funder, presented with a risk that is quite de-risked, and it's therefore quite difficult to justify necessarily the kind of the multiples that you'd want. And particularly in this PACAR environment that we're in, we've all got to be a bit careful about the overlay of the Civil Justice Council getting interested in what we're up to. And again, it just means that we have to be more responsible, I think, with what risks we are actually running. And I think lawyers have worked that out.
Thanks. I appreciate that. I'm sure the audience does as well. Michael, from your perspective, lawyers, we all like to be aware of, what the dynamic is, regardless of whether, we agree with it or impacts us one way or the other. But yes, no, point taken. Michael, from your perspective at Lockton, what are you seeing as the most significant trends between the intersection of insurance and litigation funding? I know Steve actually just alluded to your being involved, particularly in the transaction space where litigation finance insurance plays a role there. But I'm not suggesting you should limit your answer to that, but it was an interesting distinction that I thought you might want to follow up on.
Yeah, no. So it's been, and thank you, Jim. It's been in the, litigation insurance has been in the transaction space for quite a long time. It's the genesis of where this product initially came out of. And it was this product called adverse judgment insurance that they're challenging placements because you're trying to solve for adverse selection risk on that point. And, when someone's being given a hot potato, for lack of a better word, you want to make sure you're ring fencing everything appropriately, and becomes a little more complicated. But we've been seeing over here a substantial uptick in deal flow that is coming through based on awareness and knowledge of the product base. Some of that deal flow are related to things that are not insurable. At least I'm speaking in the U.S. market here. Things like, portfolios of personal injury cases, portfolios of mass tort cases are generally not going to be insurable here in the U.S. I know, the U.K., some of that might be a bit different considering the AT appetite, but in the U.S. it's pretty much a hard no on a lot of those types of cases. But we're seeing more, intellectual property, antitrust, and a lot more interest in how we can build a sustainable market that involves portfolio risks, that involves, complex pieces of commercial litigation that helps basically make a more efficient transaction for everybody. And that's really where it's starting to kind of come, where all the parties are starting to get some alignment. So in the past 6 months, I've noticed that capital sources and insurers are starting to play a lot more collaboratively than they would have, let's say, even a year ago at that point, at least in the States. I know the dynamic's a bit different in the UK because they have been working together for a long time. But as these products and offerings start to evolve in the US, we've been noticing, ways to de-risk transactions, ways to make sure folks are thinking in the same way, and a lot more collaboration and innovation, which I think is ultimately a good thing.
Thanks. Dave, so we've had a lot of discussion about changes in the judgment preservation insurance market. How has this affected your approach to funding appeals or post-judgment matters? Do you look at them differently given this recent developments that Steve touched on?
I think it's actually opened up some more opportunities for funders, and we sort of alluded to this, I think, earlier. I think when JPI was kind of at its height, it somewhat replaced funders in funding potential appeal monetizations. But with the recent trends in the market that Steve alluded to, it seems as if the premiums for these products are rising, and or the insurance products are harder to complete. And therefore, I think that opens up opportunities for funders to go back to sort of the old model from when you and I were first funding matters, 10 years ago or so, Jim, and, monetizing appeals for litigants who have judgments. That the cost of that now is kind of maybe moving back more in line or similar to, or less, sort of less expensive or equally as expensive as putting on a premium in an insurance product.
I agree, Dave, from the perspective of a litigation finance advisor, where we're often playing a brokerage role between the party seeking capital and the funders. I too see more collaboration. Everybody's talked about it here, but it's become an essential component. I know that in the early days when we were looking to get judgment preservation for an investment, it was very sequential. We would do a certain amount of due diligence. We'd prepare a memo. The insurer would then analyze that memo, then they would sign off on it, and then the deal would get done. I think a big change I've noticed today is the parties are actively collaborating at a much earlier stage in the process than they used to. And Steve, would you agree with that? And then, to shift it over, I always seem to give you the two-part question. Would you agree with that? And could you explain the shift from the single case insurance products to the portfolio-based products that you and others have mentioned?
Yeah. So yes, I certainly would agree with that, Jim. And I think we very seldom see now a fund approaching a deal like that in JPI and some of the other deals they do on the larger side of things was a big capital deployment. It's almost remiss not to think about how can insurance benefit. And because we spend so much time working through the motivation for the insurance, and the motivation isn't, well, we might lose, let's buy some insurance. The motivation has always got to be, how does this help deals get done? I think the earlier you get the broker, the insurer, and the funder around the table to work it out and collaborate, it just brings benefits throughout. And, we see some of the external advisors acting for the insurers and acting for the funders as well in these particular trades. So it is becoming much more collaborative and symbiotic. So then your second part of your question was portfolios, right?
The transition from JPI to more portfolios.
Yeah. Okay. So
I don't say from JPI, but the evolution of portfolio and
they're certainly in vogue at the moment, is fair to say. Portfolios, Jim. I wouldn't say that they're evolving to such an extent now that this is a new trend. I think portfolios have always been around. They've always been desirable for funders and for insurers, certainly. But I think we've, in years gone by, it's been much easier to identify single case opportunities, put some insurance wrap around it, put some funding wrappers around it, collaborate together and get those deals done. It just has felt like in recent times, there are more portfolio opportunities out there. And certainly we're seeing that in our book. So why is that? Is basically the essence of your question. Well, I think if you think about it from the insurer side and from the client side, okay, well, from the insurer side, the founding principle of insurance is to spread risk, right? So single case insurance is the equivalent of an insurer who does shipping insurance, just insuring, one ship. If that sinks, there's not enough spread to pay for the losses. So in litigation, we're never going to have the deal flow where you can get that large, that law of large numbers. So where a portfolio does exist, it's a really elegant way of the insurer getting, instant spread and an instant cross collateralization. And I also think that with that spread, the insurer feels they're more aligned with the funder. Okay, there have been suggestions in the past, and JPI would tend to be an example of that now, where perhaps the products have been mispriced, which leads the insurers to feel like they've done capital in the deal. When you take a portfolio approach and everyone's sharing the risk equally, I think it's easier for them to feel like they're participating in the upside without taking all of the downside. So for those various reasons, it makes more sense. It's more analogous on the insurer side to having that good spread and a good book of business. From the client side, I think they just understand it better. I think they understand the advantages that they can bring with cross collateralization. I mean, Jeremy made the point about law firms a moment ago. If I can amplify on that, I'd say that was a tremendous example. If you are a law firm and you have an ad hoc occasional deal that's perfect for litigation funding. Of course it is, and litigation funding's got an absolute centric role to play there. But if you're some of the larger law firms, perhaps where running cases on a contingent fee basis is already part of your DNA, and you have the ability to bring those cases in and generate books yourself, then there is a question: why are you giving those premium cases out to litigation funders when, if you use a combination of insurance and cheaper external capital collateralized against the policy, you can arguably become the funder yourself and maintain more of the upside. So from the client's point of view, to summarize, I think it becomes a very simple equation, and this touches on Dave's most recent point in JPI. If wrapping the deals of insurance first, even including the cost of the premium, brings down the overall cost of the financing, it makes sense. If it doesn't, and we get back to where I think we're going with JPI at the moment, where traditional litigation funding with all of the various advantages and the non-recourse aspects of it, that brings to bear, if that makes more financial sense to do it with the traditional routes on either a single or portfolio case basis, then that's the way to go. So it's my original theme throughout all of this. This is all about giving clients, advisors like yourselves, law firms, more choice.
There's a lot to unpack. There's some really great insights. Thank you. One of the things you mentioned that I thought we might want to elaborate on, and a couple others have too, about outside stakeholders, and I think you mentioned other capital sources. So as I'm understanding that, maybe simplifying it for my own benefit, so you have insurance around a portfolio of cases. Mm-hmm. For somebody who wants to invest in those cases, whether it's a funder or a traditional funder or a non-traditional funder, either way they're funding, so they're funders. The rate that the risk is much lower, and so there may be people that lack the expertise in the litigation finance space, who are therefore not comfortable investing in it, will now invest because they like the non-correlated nature of litigation finance, but they don't have to worry as much about their lack of expertise because the investment is insured at a certain level, at a comfort level, and therefore they'll be happy charging a lower rate. Is that essentially a good summary of it?
Yeah, correct. And actually,
of that point, yeah.
I would take it one step further than that, actually, Jim. In certain circumstances where we're able to insure the principal and the hurdle, frankly, the lender doesn't even care about the underlying legal asset. They're lending against the collateralization of a AA rated insurance policy, which broad church lenders, have lent against collateralized assets for hundreds of years, of which an insurance policy is a perfectly acceptable one. They don't need to get into what they perceive to be a risky asset class, being the legal asset, if their principal and return is covered by the policy. So it brings in other capital sources that otherwise wouldn't be interested in this space. And of course, when it's fully secured lending, you would expect to see the rate advantages that non-recourse lending can't compete with.
Got it. No, thanks. Michael, what do you see as current challenges facing insurers in the legal funding market, and how do you see them seeking to overcome those challenges?
Yeah, so that's a good one, and I think it comes down to a little bit of a difference between the U.S. and the U.K. So I'm going to do this more from a U.S. perspective because I have a team in the U.K. that operates there, and your legal system in the U.K. is a bit different than here in the U.S. I think the big challenge that is facing the insurers right now is understanding what the box is going to look like of what will be insurable, and kind of dealing with potential conflict issues that come up in litigation, making sure that what they're supporting leads to the appropriate financial and rational financial outcome. I think that's really the biggest challenge that's coming through, is making sure that the policies are being used to create a more efficient litigation process, and less of, everyone's trying to get a crazy return and things like that. I think it's really looking, at least in the US at this point, a bit more on how is this insurance policy being used to get a transaction done, and getting that transaction done in, a rational way. And a lot of this is the insurance policies, when we're talking about it, as Steve was pointing out before, kind of turns this very esoteric asset, the non-recourse litigation finance, into a bit more of a credit type instrument. And because of that, different costs of capital come in and the like there as well. I also think, the market has been asking insurers to do these types of mass tort cases or other cases that we know litigation funding has supported in the past historically. And the insurance market isn't really at a point where that is going to be viable in the near term. And I don't know if it's going to be viable in the near term or in the long term for those particular types of products. So it will be looking more on this commercial litigation component as well.
Got it. Dave, what are your thoughts on the trend of insurance products helping law firms access capital, as Steve was just talking about? Do you see this as a threat or an opportunity for traditional litigation funders?
Yeah, I think the jury's still out a little bit. I think it could be a little bit of both. I certainly can see opportunities where, or situations where the WIP insurance might replace, traditional kind of litigation funding portfolio arrangements between funders and firms. But I also see opportunities where many firms still don't want to go out of pocket for the premiums that they will have to pay to put such a policy in place. And so there's another opportunity for law firms, funders, and insurers to all collaborate together, because you can use the funder to finance the premium.
And are you starting to see those opportunities?
Yeah, we're starting to see some of those.
And do you worry, or should I ask it differently? Are the IRRs that are available to you ones that, I guess every fund is different, but I'll still ask the question, that your investors or that are high enough to complement the other parts of the investment you're making? I mean, you made a great example earlier where insurance played a small but important role in getting the deal done. But on the type of product you're just describing, where the law firm has portfolio insurance and is seeking capital, let's say for the premium or to advance costs on WIP, which for those of you who don't know is work in progress. What are your thoughts on that?
I'm going to give the very unsatisfying answer of it depends. I think, it's going to depend on the particular, product and collaboration that you're working on and what the pricing is there. And it's going to depend on the particular funder's cost of capital. And it's going to vary, I think, across funders and opportunities.
One of the things that it does do, because the nature of the deposit premium is that it's coming very early on in the process, often at the stage where you're also invited to fund historic costs of the law firm when you've decided to fund, is it does allow the funder to apply a bit of pressure in respect of how the law firm has to cooperate with the funder to get the thing off the ground, simply because of the immediate outlay of capital that's required for the insurance product. But it's a very good test at an early stage of collaboration, because it's a big ask at the beginning of a case. It also impacts on an early settlement, because it means that there's a disproportionate amount of the insurance premium as against costs of the budget of the lawyers. So there are factors both ways.
So that raises an interesting question for you, Jeremy, and maybe Dave as well. So you make a good point that the law firm, in seeking the insurance, in part may be in a situation where not only are they thinking about paying the premium for the insurance, but they've put a lot of investment into the case already. Maybe it was in the diligence component, working up the case and evaluating whether or not it was something to take on. It seems to me, but I'm asking, that a benefit that the litigation funder can provide is funding not just the premium, but funding the historical, incurred costs / attorney's fees. Have you, either of you, Dave, you're nodding your head, so I'll start with you. Are you seeing those types of scenarios?
Sorry to cut across you. Yeah, we've talked about it. We haven't done it yet, but you raise a good point just about the distinction, between the insurance and the funding. The funding is usually just, upfront cash in the pocket of the law firm, which is a different benefit than, ensuring the loss of the fees that they would otherwise earn down the road. And, some firms will choose one versus the other, or both.
Got it. Well, Michael, I'm going to give you the last question, because I know we're cutting close to our time before we turn it to the questions that have come in from the audience. How do you think insurance brokers, and maybe we'll let Steve weigh in on this too, it's only fair. How do you think insurance brokers add value in complex litigation funding scenarios involving multiple stakeholders? I mean, you've given some examples of collaboration and maybe what I called a little bit of mediation, but what do you think is the biggest value add that folks like you and Steve bring to the table in these deals?
Outside of just the market knowledge that comes with doing a lot of these transactions and structures, I think a lot of it will come down not only to the mediator role, but considering I've worked on multiple deals, done a lot of really unique structures here in the States and a lot of different ways. Sometimes there'll be things that might work in one deal that we can be figuring out with the insurers that might work in another deal, or understanding what the deal pressures are from the funder side, what their pain points are in order to get something done, or what the pain points are from the insurer side on a particular transaction. So I think it really does come down to having a bit to manage all the expectations of the stakeholders appropriately when you have multiple stakeholders, and make sure everybody is kind of knows where things stand, understands realistic timing expectations as well, and being really clear and upfront. The diligence process is probably the area where I think we're talking about the most collaboration will have to go on in the diligence process, understanding how that works, knowing that the carriers, report that they're going to do is not something necessarily the funder is going to be able to see, because that is the carrier's attorney work product. And the funder sometimes will they have to hire their own lawyer to do their own diligence on this stuff. So to the extent there's a lawyer involved, if there's a law firm involved, working with the law firm and the insurer just to understand those points as well. If it's just a case where a law firm's coming out of pocket for the premium, which has happened more times than I initially expected it would happen as well.
Oh, great. Thank you. Steve, anything to add to that?
I mean, look, I would obviously echo it, so I'm not gonna take up the panel's time in repeating the excellent points Mike makes. But I think the one extra word that I like to use when we're approaching a deal from a broker perspective is triage. I think we can all spend a lot of time on deals which aren't going to go anywhere, either because the request is wrong, the economics don't work, it's more appropriate for funding than it is for insurance. And Mike mentioned about expectation management. I think that goes into the triage phase. And if you come to the broker knows what they're doing, we can properly triage it. We can make sure it's ready. So then when we ask funders and or the carriers to spend their time thinking about it, then we've already done 90% of the thinking, and we know the client's got the gumption to pay for it. They know how much it's going to cost, and it works from a legal and from an economic perspective. So that triage process, I think, is quite underrated in the broking space.
Yeah, and think that that's what I was getting to with expectation management. So appreciate you being flushing that out a lot more, Steve.
There you go.
And I'd be remiss if I didn't end by saying I agree with both of your points that market knowledge is key. And, also as a broker, I think the biggest value add we all bring is a level of market knowledge that an individual funder or a lawyer might not otherwise have. So with that, I see John's back on the screen. I'll turn it back to you. And thank you, everybody.
Yeah, thanks so much, Jim. Appreciate that. And we do have a few questions here from attendees. So I'll start with the first one. This is a bit about market, what's going on in the market right now. Do we know how many litigation insurance claims have been made over the past 6 months, what the quantum of total claims has been? And more broadly, how is the space trending right now? Is it trending downwards or upwards? Has the insurance market and the reinsurance market, have those been a bit spooked by recent claims?
Steve faced that last time, so Michael, I think we got to start with you on it.
Yeah, I can't publicly comment on a lot of that. A lot of it's just going to be rumored innuendo, to be perfectly frank, at that point. I will say, just to echo kind of some of Steve's points before, what we have noticed, at least as it relates to the judgment preservation product, and I think it also bleeds over a bit more into the defense side product too, is carriers being more conservative, lower limits, and the amount of capacity available out there is less than it was 6 months ago.
But the claims are getting paid. I think that's a really important point. The claims in this space, they're written by big boy carriers with broad shoulders, and they're paying the claims, and they are evaluating the lessons learned from those losses and the market will continue to evolve and develop to make sure that we can still offer clients choice and good quality products which support their requirements.
I might think that's a great point, Steve. I might think the fact that they're being paid would increase demand, which
there is no better marketing for an insurance broker than a paid claim, obviously now.
Yes.
The carriers wouldn't thank me for saying that, but that is the reality, and this market only exists if claims get paid.
Unfortunately, you can't say the same about the funders, because one way of answering the question, John, is to look at the number of claims that have been funded that have lost lately, and there are a few of those.
Good point. Very good point. Are there any alternative risk transfer vehicles that are suitable for these types of risks? So like captives or ILS?
Yeah. There have been some interesting endeavors where folks have started to look at the captive market or the insurance-linked security market in order to figure it out. It's still early stages on that right now, and most of these are being written by, as Steve has said before, like your broad shoulder carrier, your larger carriers, than these more esoteric insurance structures. That's not to say at some point in the future those might become a bit more commonplace, but if we're talking about the litigation insurance market being, and I'm going to use a baseball reference here, in the first or second inning, this one would be the ILS play, or the captive play would just be warming up to bat and, in practice, as opposed to even getting in game.
Yeah.
Got it. All right. We have one final question here. How much emphasis are insurers now placing on adverse selection? Are insurers implementing any mitigating strategies for that now?
You want me to take this one?
Sure.
So look, adverse selection has always been key to any underwriter's assessment of any risk, right? So we're not just talking about the litigation industry here. Anywhere when you turn up and you're trying to buy some insurance for something, the question is, from the insurer's point of view, what don't I know? And it is a bit more stark in the litigation industry because you might have, organizations, funders, law firms, etc., that have got the ability to repeat buy and quite often don't. Of course, that's going to ring alarm bells. And again, I think the easiest way to answer that, John, is as per my earlier answer on portfolios. Quite often when these portfolios have been put in place, one of the policy conditions is that everything goes in. You can't cherry pick. And as a result of that mitigant being put in there from the underwriter's point of view, we then as the broker expect to see, better pricing, better turnaround times, better underwriting, broader underwriting appetites to make sure that if everything's going in, then everyone shares in the risk equally.
All right. Great. We got one final question. So let me get this last one in here. In the context of evaluating WIP insurance, looking at a fund like Dave's with and without it, does the settlement range that make everyone happy, does that change?
I'm not sure I understand exactly, but I think when a funder is looking at any potential investment in conjunction with the lawyers and the client on the case, they're trying to analyze what's sort of the most likely reasonable outcome in the case or portfolio of cases, and trying to accord the potential funding commitment with that expected value and make sure that there is enough of a ratio and enough of a cushion for the funder to get its return, for the law firm to get a return, and for the client to be getting a healthy return. And so we're always kind of slicing and dicing and sort of never really taking the first numbers that we get at face value. We're always usually applying some sort of haircut or discount to it to make sure that there's a reasonable return in the case. And so that's sort of always the analysis, whether it's, I think, WIP insurance or traditional portfolio funding or single case funding. We're going to make sure there's enough value in the expected return before we're committing to funding. So I don't think it changes the analysis.
All right. We'll have to end it there because we're at the top of the hour. So really appreciate your participation. Thank you all for joining today. We hope you enjoyed this discussion. Great to get a range of perspectives on this topic. So I want to thank our panelists, Dave Kerstein, Jeremy Marshall, Steve Jones, Michael Parrish. Thank you so much for diving into an amazing amount of detail there. We covered a lot in the last hour. And of course, our moderator, Jim Batson, did a fantastic job. Thank you so much, Jim. Just a reminder to everyone that you will all be receiving a link to the recording of this event. Please stay tuned for that. So we hope you enjoyed this. And of course, you can check out past conferences and view our daily reporting on the industry. Again, please visit www.legalfundingjournal.com. Thank you all again. We'll see you next month at our next digital event. So take care, everyone. Have a great day.
Thank you.
Thank you, everyone.
Thanks a lot.
Bye-bye.
Bye-bye.